Today we're going to talk about why someone would want to buy a property that is negative cash flowing. I happen to buy a negative cash flow property as my first investment property, and it is something I would highly not recommend to any beginning investors out there. If you're more experienced, you could probably handle what I'm about to share with you today on what can go wrong with a property that negative cash flows, but if you're a beginner, tread carefully. Why in the world would someone want to buy a negative cash flowing property? There's going to be two reasons. Number one reason is going to be a high likelihood of appreciation over time, and I would recommend that it is not a small appreciation, it is a large appreciation, because if you're going to suffer the negative cash flow in the moment, you're going to want a big payday down the road. And number two, this could be depreciation as a tax shelter. So if you're a high income earner, maybe if you're in California or New York, you're making $180,000 a year and you get taxed really heavily, maybe you can buy a property that depreciates at a large rate, and that helps shelter some of your tax that is going to the government. And if you want to add in a third one, it is the loan pay down. You can count that as equity or money in your pocket in a sense. Even though it's illiquid and you can't access it, it is nice to have some money in your pocket in the form of equity at the end of each month, even if you are negative cash flow from a cash flow perspective. Let's jump into the computer. I'm going to show you exactly what I'm talking about with the property that I purchased. Let's go on over to Zillow, and we're going to go to the property that I purchased, and we will look at sold. So imagine that you are reaching out to homeowners and you're looking for small multifamilies like I was, because that's the mania of today. And I'm going to go ahead and get it down into the multifamily. So this is about right. So let's just say you're looking at an area, whoops, and you're seeing that, okay, the multifamilies in this area are going for, there's one for 310, there's one for 410, down the street you got 402, 320, 335, anyway, you get the point. You see that anywhere from $300,000 to $400,000. So you talk to a seller and a seller goes, wow, I'll sell it to you if you want to buy it, but you know, the best I can do is $275 or something. So you're getting it under market value. As you see, basically all of the properties are going for above $275, but let's say it cash flows negative. Well, this is a scenario where you might want to look at how much built-in equity you have and what kind of financial position you find yourself in. So anyway, so for my specific example, I was looking here and I could see at the time that the properties were going for roughly like $250 or so, $255, maybe $260. And what I actually did is I wanted seller financing. I wanted very little money out of my pocket, and I didn't want to deal with the banks because I wouldn't have had enough money for the down payment, and I wouldn't have had the ability to get a traditional loan on the property. So I knew I had to do seller financing. So what I did, and we'll go to the handy dandy notes here, so I offered $260K purchase price. We agreed upon an interest rate of 6.5% interest rate, and I underwrote for all the taxes and insurance and all the utilities that are paid for the owner. And essentially what I came out to is my pity was somewhere around like $1,800 a month. For those that aren't aware, that's mortgage, principal and interest, the taxes and insurance. $1,800 a month. I had a property manager, and she cost 10% of gross rents, which came out to be right around $255 a month. And when I took the property over, the gross rents were $2,550 a month. So what I was looking at was something like $2,300, $2,400 a month, all-in expenses, and that was with like very minimal repairs. And unfortunately, I was a little ignorant. This was my first property, so at quick look, you go, oh wow, it's cash flowing, even though I only needed $20K down. I didn't have to deal with a bank. It was good terms, right? Well, what I quickly found out is that the property didn't actually cash flow. Now, let me add a side note, and why I'm making this video is when I did purchase it, properties had gone from $250K all the way to $300K up to maybe even $310K at the time I purchased. So I still wanted to go through with it because I knew I was getting a lot of instant equity, and just throughout America I could tell how many people wanted to get in on these fourplexes. There was such the craze, Bigger Pockets community, everyone was talking about it, so that's why I wanted to purchase. And I'm going to bring you over to my accounting. So I would highly recommend keeping accounting for those new investors out there. You can see I've got all my properties and my LLC operating expenses. I would highly recommend doing a really thorough job of accounting. So here is the spreadsheet for the property, and I'm sharing it with you because I want you to see behind the scenes. of what it's like to actually own a property that negative cash flows. And besides going through all the numbers, which I won't do, a few things to note. Insurance right here. I underwrote for about $60 a month, I think was what the previous owner was paying. So one learning lesson that I learned in this is that the insurance company can actually raise the rates on you without you knowing. So we agreed, when I first took over the property, it's $62.50 a month, which at the time meant that I was a little bit in the positive for cash flow. But I quickly found out that they can increase it, and you see here there were a few months at $265, which I was kind of taken aback. I thought maybe it was for a month or two, but after 3 months I had to call, and it was absolutely ridiculous. Now the reason for $343 here is I switched and paid, I think it was 2 months for sign up. So that I was able to get it down to $174, which is 100, roughly what, 90, 89 bucks, 91 bucks or something off what I was paying. But that 300 extra, or really from the $62 I was expecting, these 4 months from January to May, I mean, that was a huge shock to me, which really sucked. Everything else was pretty much in line. The utilities were a little bit more than I anticipated. I knew I was paying them, and I underwrote right around what I was paying them, but once it comes out of your pocket is when you really start to feel it. But where I really got hit was the miscellaneous repairs, and this can be a whole video on itself, but if you're a new investor and you're just looking at a spreadsheet and you go, man, this makes great sense on paper, just remember to really analyze the properties you're buying. This was what some would consider in like a D+ area. It was probably a D- property though. A lot of maintenance and repairs on these in Las Vegas. Now some markets have multifamilies that you can buy and not really have to worry about a lot of repairs, but I will say if you're buying in a C- D class neighborhood, there's probably going to be more repairs than you anticipate. And BiggerPockets is all about putting like 10% on the paper and doing some random number, which means absolutely nothing. Look at the spreadsheet here. In the 7 or 8 months I owned it, $3,500. That was rough. And you can see the most important number here is the total net income. I was under almost a little over $1,600 for owning it for 7 months. And really the purpose of this video is I want to tell you why you would want to buy a negative cash flow property, because I sold it for $50,000 more than I purchased it for in 7 months. But what you really want to understand with a negative cash flow property is it really, really sucks. Some point you might have a moment in life where you have something go wrong and you need cash, and the next month is May, as you see on the spreadsheet, and when I was under $1,700, that sucks. And then when I went to sell it in July, there was one unit that needed work and I didn't have the money, and I'll make plenty of videos on why I didn't, but in that moment in time I didn't have the money and I wasn't able to fix it up. It was going to take $1,800 to fix it up. That was what I was quoted at. And really on some of these properties, all the units need work. So you can see $1,600 of negative cash flow in 7 months. That one unit needed $1,800, so now we're down to negative $3,400 of cash flow. And then realistically, all the other units probably needed a little bit here and there. There was going to be high maintenance. I mean, shoot, I averaged something like $500 a month, $600 a month for repairs, and that was never ending. So this thing would have continued to negative cash flow throughout time. Now the depreciation would help. Again, if you're making a lot of money in other properties and you're paying a lot of taxes and you're getting a property that has a good chance of appreciation, high loan pay down, whatever the case, and you want to use it as a tax shelter, be my guest. But if you're a beginning investor, make sure you really understand this, that when you buy a property that is right at break even, that you think is break even, you're a few unfortunate circumstances away from really losing money on a deal. And I was insanely thankful that the market took off here in Vegas and I was able to sell for $50,000 more than I bought it for. And these properties are crap. They are not good. When it was purchased by someone at $310 of cash, I was so happy because I felt so bad for the next purchaser. He's going to have never-ending work on this thing, and it's going to cash flow for him because it's a cash offer. But oh man, I could talk about it for days, so I'll stop now. But anyway, here's all the numbers, all that goes into it. Hope you really enjoyed this video. I want to make a really quick one. If you learned something, that's awesome. Please leave a comment below. Please let me know what you learned, or if you want me to make any videos in the future on anything that could help you out, I'd love to. Thanks again for watching.